All right, welcome back to the show, everyone. It's Mitch Goldberg. You're watching my live stream. Be the boss of your money. Is it me, or does this week feel like a 10-day week? It's just been going on and on and on. Silicon Valley Bank, day in, day out. Is the world going to fall apart or not? We wait with bated breath. I'm on the record because I said it on the live stream and other places that this is not a Lehman style takedown of the economy, of the stock market. Um, not even close. And I'll tell you why I say that. I think it's important, if you are interested. I take little snippets from these live streams every day and I post them. I scatter them all around. I post them every day on Instagram, LinkedIn, Facebook. So keep an eye out for those. And if you like them, give them a thumbs up, so you could let me know if you approve, if you like, and I'll keep making them. All right. So just want to share that with you. And if you are into YouTube, check out my YouTube channel, Client First Strategy, and subscribe while you're checking it out. And the easiest way to find all of my content is on Instagram, because I really just, when you go on somebody's timeline on Instagram, all you see is what they post, not all the things that they like and all that. So it's just a quick and easy way to see what is there. So check out Instagram. It's at Insta Mitch G. It's a pretty cool Instagram handle, right? So let's get into the show. So looked like another down day in the morning, and I do a radio show every morning. I don't know if you know that, a live show. And I always say that however the futures look in the morning, that's just a snapshot. If I did the show or this show at 2 in the afternoon, I would just say, here's where the markets are right now. So I don't put too much stock, no pun intended, into where the futures are in the morning. But today turned out to be a fairly decent day, but a much needed back up day, and a much needed relief day. First Republic is the story of the day. It's a story every day. Is that the next domino to fall? Because we just wait. Are we if we keep seeing dominoes fall, then we have to start questioning when there's an end to this. So the big thing to take away, though, from all this going on with the banks is, excuse me, are we going into a recession or not? I think that credit tightens. It's going to get harder to get credit. I think banks are going to be on their best behavior, because right now every bank in the country is being scrutinized by the regulators. They're all going to be checked out for reserves and how much of their deposit base do they invest. They're going to be doing all these things that the regulators have to check everything. So banks want to make sure they're in compliance with everything. They're just playing everything right down the middle with following the rules and regulations. It's going to make credit a little bit tougher to come by. I think that is another hit to the economy. I've been in the soft landing camp for a while, but this tilts me into the mild recession camp. And we'll see as more developments come in. I'll change my mind if I need to, because that's what I do. When the new information comes in and it's powerful enough, you accept it, you change your mind, and you move on. This is why I don't get married to any particular point of view when it comes to the market, because things change. It's very fluid. And just when you think you have control over things, or when you think you have everything figured out, the market is great at reminding you that you have nothing figured out, except invest for the long term, create a plan that will change undoubtedly as time goes on. People think there's something special, some be all and end all of a financial plan. I do financial planning. Uh, these are only as good as the inputs, and they just take everything up till today and extrapolate everything to the future and spit out a number. But that really is the worst thing I think I could do to people. So I just really take that with a giant grain of salt, and just help people focus on what they can control, what they should give up on worrying about, what in their life can they automate in terms of financials, and help people really think through the cost of a big discretionary item. And people often will justify things with YOLO. You only live once. But it's not really a good way to justify things because living with regret is not such a great thing either. And we get into all these things. That's what a personal financial advisor does. And if you want to take this conversation offline to a one-on-one basis with me, check out Client First Strategy. My contact information is there. Reach out to me, and we'll set it up. We'll get it together. Get it together, I guess. So let's take a look at how things did. There's news coming out like literally every second, and I would love to, at some point you have to stop looking at every piece of news and figure out what you want to do. But let's go to the screen, pop myself up in the corner, get rid of the social media icons. So the Dow is up 1%, up 1.17%, up 371. Nasdaq up 2.5%. That's a decent day, up 283. S&P was up 68 points, up 1.76%. Decent day right there too. Oil bounced off a little bit off its recent low. It was down to like 66, 67. Now it's 68. 10-year yield is, it's coming back up a little bit. There's mixed emotions. If you want the 10-year yield to stay down, but that would mean there's a problem brewing. You don't want it to go up too much because that would mean the economy's too strong and inflation is growing too much. So where we want the 10-year yield to settle is probably around like 3.8. And I think we'll be good. The VIX was down a lot today, down 12% at 22.99. And the VIX has been trading at a range of like 18 to 22. Now recently with this bank calamity, it's been like 23 to 28. It's coming back down again. And I think investors are just getting used to the fact that we're going to have these bank shock, these aftershocks, these tremors going on for a while. But by and large, I feel that the banking sector of our country is in very good shape and is ready to withstand whatever is going to be thrown at it. And we have a good idea of what's going to be thrown at it. Today, the European Central Bank raised rates 0.5 point. Our central bank, the Federal Reserve, meets next Tuesday and Wednesday. And Wednesday, they announced what they did with interest rates. The going bet is that they raise rates by 0.25%, or they do nothing. Most people are at 0.25%. I think 0.25 point means nothing on top of what the Fed has already done. So why even bother doing it? And let the economy, the banks, everybody else catch up to the actions of the Fed. They've raised rates from, they've raised rates like 475 basis points in the last 12 months. That is a massive amount. Let's see what it looks like. That's just me. Okay, doesn't have to be you. Let's take a look at the bond market. So yields, for the most part, are still 4s and short-term yields, okay? So when you look at 1 year and under, we did have a 6-month, 1 year, 4-month, 3-month, all over 5%. So, I've been pounding the table on these. If you have cash for the right reason, cash you're leaving for a period certain, short-term, or you don't want to leave your money in the bank, treasury bills are a good place to be. Now, being that the 6-month is still just about 4.9% versus you could have maybe had 5.1%. That's still a pretty darn good yield. I would make a 5. Oh, I could have had 5. A tenth or 5/10, not even 0.2% is really not. It's not what's going to make you or break you. And the reason we say, I always say, buy laddered treasuries, buy the 3-month, the 6-month, the 9-month, the 12-month, and the 2-year, is for exactly this, because you don't know which rates are going to come down, the short ones or the longer ones. And you want to diversify your maturity levels. And this way, when one matures, you can always roll it over into a new bond. That's what I like to do with bonds. And same thing with CDs and treasuries. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. I have to say that. Disclaimers. Anyway, let's move on. The 10-year yield is at 3.57%. Getting back up there. It's been about, it's been struggling to stay above 4%. And that's because nobody really believes the economy is going to be that strong for much longer. So that's why. Okay. By the way, while you're watching this, I got a thumbs up from Menley, thank you, Menley, for the thumbs up. Right back at you. I really appreciate that. So, guys, while you're watching, or if you're watching the replay, give it a thumbs up. Ask me questions, or if you hear something that you like, hey, that sounded good, or a good point, Mitch, write in the comments. Good point, Mitch, and I'll appreciate that, and it'll give me some encouragement. Words of wisdom are always appreciated as well. Let's take a look at the banks. Let's take a look at First Republic. First Republic is down almost $5 a share after market trading, after being up $3. Okay, so the stock is actually lower now than when it started the day. Now, it was down a lot today. You take a look at the low of the day range. It was 1980. So let's call it was about 20, and it finished at 34. So there's a lot of action, a lot of money to be made intraday. However, I think most people kind of buy it, they sell it. They don't really know what they're doing. They're trying to catch a trade. But if you bought it, aside from the opening trade, today, it's down almost $5 after market. So you're probably not even making anything on the stock. And this is why it's so tough to be a trader and to do it consistently. However, if you must try, better to be early than to be late. That's what I say. All right. What else are we going to look at? If you're going to buy the banks, should you buy the banks? Okay, so let's get into that, because regional banks were always this nice little, this nice little polite corner of the stock market where conservative management, managements know their towns that they operate in, they know their customers. It's always been this nice place to be, and somewhat boring, consistent, nice dividends, but not a place where you make a ton of money. It's just it's a step above investing in the utility sector is how I look at it. Until you have this rockiness from Silicon Valley Bank, and then investors are questioning who's going to be next. First Republic, first it was Silicon Valley, then it was Signature Bank, and the third worst bank in terms of how much of their assets, deposits that they've invested in longer dated securities is First Republic. That's why First Republic is always the one on the tip of everybody's tongue, because if there is another domino to fall, it's going to be First Republic. They're getting a lifeline of something to the tune of $20 or $25 billion in, I think, just actually in deposits from J.P. Morgan, Citi, Wells Fargo, PNC is throwing in some money. A few other banks are throwing in some money. They don't want to see this bank collapse because they know that it's not going to be so great for them either. Should you buy the ETF? I want to take a look at the exchange traded funds. Here's one for you. This is IAT, okay, and it sports a it sports an expense ratio. It's 0.39. But look at the top holdings in this: PNC Financial, U.S. Bancorp. Okay, let me pat myself up here. Boom. Okay. U.S. Bancorp, Truist, M&T Bank, Fifth Third, Regions, Huntington Bank, Citizens, KeyCorp, First Horizon. So the top 10 make up about 70% of the ETF. So if you're going to buy these high quality, large regional banks, there are a couple of exchange traded funds which give you the, a complement of these regional banks in a nice, inexpensive wrapper in an ETF. And I think that's a really solid way to go for people who don't know which bank to buy, but they know they want to buy the banks and they want to get that that comeback. I don't think this is a one-day thing. People tend to treat down markets or market problems like it's a one-day event. And I remember about a year ago when the Fed started to raise rates, the market started to go down, and I said, I said banks going, I said the stock market going down. I said it's not a day event. It's not an event. It's a process, and we're fighting through the process now. And what you're seeing, by the way, with having problems with banks, every time we go into a recession or come close to a recession, this always happens with banks. Something happens with banks. Maybe not this exact scenario, But banks almost always have a problem in every recession. It's like they always have a problem in every recession. So this is no different than every time the world is coming to an end, the banking sector is going to die, and nothing's going to be good again. And then we get through it. So I think the banking sector is incredibly healthy. Now, what makes this different than 2008? In 2008, banks loaded up, not all of them, a lot of them loaded up on derivatives, these esoteric investments that not only did they become worthless, but the banks that owned them actually owed money in them. So not only are they in zero equity, but they had negative equity. If you liquidate the bank, you wouldn't even have anything left. Actually, you'd still have more bills to pay. Today, with like a sovereign bank, for example, or any banks, like let's see the Westpac, the ones that are always in the news, okay, First Republic. If they were to liquidate, they would still walk away with probably 80 to 85 cents, maybe even 90 cents in the dollar. So that's a much different call. And that's why I'm not so worried about a massive systemic failure, because they do have assets. They're just not enough to cover the depositors that want to take their money out. But they do have assets. So make no mistake, this isn't like a total haircut and then some. It's a very big difference compared to 2008, 2009, when we had a really major problem in the economy. Speaking of the Fed, you remember I said the Fed might raise a quarter point. The Federal Reserve has changed course in the past. Jerome Powell in late 2018 raised rates 3 times, and then just stopped and cut rates again. He pivoted. So he has shown that he is open-minded enough to make a pivot when it's time to do it. So let's hope he does that again, and let's hope he doesn't raise rates. I don't think it's necessary. Another quarter point hike, and then the Fed says in their presser after the announcement on Wednesday of what they do, if they come out and say, yeah, we're going to cool it now, or if they don't raise rates at all, I think you'll get a good effect from both. But I think that, to raise rates one more time just because you're worried about your credibility and you said you would raise rates. No, the facts change your mind. I think you're doing more harm than good, but I don't think one more quarter point hike in rates is going to change the equation for everybody. All right. I think we've covered just about everything I want to cover today. I thank you for watching. I'm going to get going. I have a dinner with my friend Steve at 6. I've got to run to the supermarket, pick up a couple of things, and then go home. Oh, tomorrow on my radio show, I'm having James Medor from Newsday. We're going to talk about all things automation, artificial intelligence, banks, you name it. He is a phenomenal business reporter, economics beat at Newsday. So if you get my radio station, if you get the channel, listen in, and I'll have more to say about that in the coming days as well. All right. Have a good night, everybody. And thanks so much again for joining me. I really appreciate you.